In 2014, a man died in Brattleboro, Vermont at 92 years old. He wore a coat held together with a safety pin. He drove a second-hand car and cut his own firewood. The people in his town knew him only as the quiet janitor. For decades, he swept floors and stocked shelves at a JCPenney. Before that, he pumped gas at a filling station on Main Street. Nobody in that town thought he had two nickels to rub together. He waited in line for coffee like everyone else, saying almost nothing. Then the lawyers opened his estate, and the number stopped everyone cold. Ronald Redd left behind almost $8 million, $8 million, built by a man who earned a janitor's wage. He never inherited it, never won it, never sold a company. He built it quietly, one small decision at a time for 65 years. And what he knew is something almost nobody talks about out loud. It wasn't a secret formula, a hot tip, or a hidden shortcut. It was a handful of dull ideas that he followed for a lifetime. The same ideas most people hear, nod at, and then completely ignore. By the end of this, you'll understand exactly what he did differently. Here's why this matters to you. Right now, today, the median American aged 55 to 64 has about $185,000 saved. For those 65 to 74, the median is around $200,000. And more than a quarter of near retirees have essentially nothing saved at all. Ronald Read had none of the advantages we assume you need. No college degree in finance, no rich family, no six-figure salary. No hedge fund, no crypto, no secret startup that went to the moon. He had a modest income, a library card, and a very long attention span. Most people believe getting rich requires a big salary or a lucky break. They believe you need to pick the one stock that changes everything. That belief is exactly why most people never build real wealth. Because the thing that actually made Redd rich is boring, slow, and available to you. It doesn't require permission, connections, insider tips, or luck. It requires understanding a kind of math that schools never teach. It also requires a temperament that almost nobody bothers to build. Before you dismiss it as impossible, hear this next part carefully. Here's what the data actually shows about how he really did it. Let me tell you who Ronald Read actually was, in plain detail. He was born in 1921 on a small farm outside Brattleboro. He was the first person in his family to graduate high school. To get to class, he reportedly walked and hitchhiked several miles each day. That long walk to school tells you almost everything about the man. He served in North Africa and Italy during the Second World War. When he came home, he took ordinary jobs and never left his hometown. For 25 years, he pumped gas at a Gulf station downtown. For another 17 years, he was a maintenance worker and janitor. He married, raised stepchildren, and lived in a small, modest house. By every visible measure, Ronald Redd was an average working man. He fixed his own things and rarely bought anything he didn't need. His neighbors saw a frugal old man and quietly felt sorry for him. They had no idea they were living beside a self-made multimillionaire. He tipped modestly, clipped coupons, and repaired what others threw away. He once fixed his coat with a safety pin rather than buy a new one. Yet inside a bank vault sat a 5-inch stack of stock certificates. That contrast is the entire lesson wrapped into a single quiet man. Now let me show you someone we'll call the typical modern investor. Meet Diana, 34, responsible, stressed, and convinced she started too late. Diana earns more in a single year than Redd made in 3. But Diana checks her brokerage app 11 times before lunch. She buys a hot stock, panics when it drops, and sells at a loss. She chases whatever trend her coworkers are talking about at lunch. Every year she pays fees, taxes, and the price of her own fear. She feels busy, informed, and modern, and she's quietly falling behind. Read and Diana had access to the exact same stock market. They read the same headlines about crashes, bubbles, and booms. But they did almost everything in the exact opposite way. Read bought small pieces of boring companies and simply refused to sell. Diana bought excitement and sold it the moment it scared her. One of them treated investing as a decades-long marriage. The other treated it like speed dating with her life savings. Let's keep this fair and run the numbers on both approaches. Because the gap between these two mindsets is not small at all. Over a lifetime, that gap can be worth millions of dollars. And the reason has almost nothing to do with raw intelligence. It has to do with a handful of specific, repeatable decisions. Read made those decisions on purpose, for 65 straight years. Diana makes the opposite decisions without ever realizing she's choosing. And here's the uncomfortable part for anyone making excuses right now. Reed's income was low, and that never once stopped him. He didn't wait for a raise, a bonus, or the perfect moment. He started with what he had and let time do the rest. Diana has more income, more tools, and more information than he ever did. What she lacks is the one thing money can't buy: patience. So let's break down exactly what Ronald Reed understood, step by step. Here's the first thing almost nobody tells you about building wealth. Your savings rate matters far more than your salary in the beginning. Friends said Red saved close to 80% of what he earned. Think about that number for a second, because it is genuinely extreme. Most financial advice tells you to save 10 or 15%. Reed treated saving like oxygen, not like a leftover at month's end. He drove old cars long after they stopped being fashionable. He famously parked far away in town to avoid feeding a meter. He cut his own firewood by hand well into his 90s. None of this felt like sacrifice to him, and that is the entire point. A high savings rate quietly does two powerful things at once. It gives you far more money to invest every single month. And it lowers the lifestyle you actually need to feel content. That second effect is the one almost everybody completely forgets about. If you only need $30,000 a year to be happy, freedom is cheap. If you need $300,000, no salary will ever feel like enough. Red won the game partly by needing very little to feel rich. A person who spends everything is running on a treadmill forever. A person who spends little is quietly building an escape hatch. Here's what actually happens when you save hard and invest the difference. The money you don't spend becomes an engine that works while you sleep. That engine never takes a day off, never asks for a raise. And that engine runs on the second thing Reed understood deeply. That second thing is compounding, and it is badly misunderstood by most people. Compounding means your gains start earning their own gains over time. A dollar invested does not grow in a boring straight line. It grows in a curve that bends sharply upward near the end. There's an old shortcut for this called the rule of 72. Divide 72 by your return to see how fast money doubles. At 8%, your money roughly doubles every 9 years. So $1 becomes 2, then 4, then 8, then 16. The last doubling adds more than all the earlier ones combined. Imagine roughly $300 invested every month at 8%. Over 65 years, that steady habit grows into millions of dollars. The early decades feel painfully slow, almost like nothing is happening. For the first 20 years, you might feel like you're wasting your time. Then the curve wakes up and the growth becomes almost violent. Most of Red's $8 million appeared in the final stretch of his life. The tree he planted in his 20s gave shade in his 80s. Here's the part that hurts, and it hurts on purpose. The single most powerful variable in that whole formula is time. Not the amount, not the perfect stock, not the timing of the market. Time is the one ingredient you can never buy back later. A person who starts at 25 and simply holds has a massive edge. They can beat someone who starts at 35 and saves twice as much. Those 10 extra years quietly do more work than double the money. The market doesn't reward the smartest investor in the room. It rewards the one who stays invested the longest without flinching. Reed stayed invested for 65 years and flinched almost never. Let me make this painfully concrete with two ordinary savers. Picture Emma, who invests $200 a month starting at age 25. She stops adding money completely at 35 after just 10 short years. She invested $24,000 total, then never contributed another dime. Now picture Larry, who waits until 35 to finally begin. Larry invests the same $200 a month but never stops. He keeps going faithfully for 30 full years until he turns 65. Larry contributes $72,000, 3 times as much as Emma. Yet at 8%, Emma still ends up with more money than Larry. 10 years of a head start quietly beat 30 years of effort. That is not a trick. That is just what compounding does to time. This is the exact edge Ronald Reed gave himself by starting young. He began investing shortly after the war and simply never stopped. Every year, he stayed in the market stacked on top of the last. By 92, he had let compounding run for over 6 decades. That is why an ordinary income turned into an extraordinary fortune. Now here's what nobody tells you about which stocks he actually bought. People assume he must have found some secret rocket ship company. The truth is almost disappointingly ordinary, and that ordinariness is the lesson. Reed owned at least 95 different stocks when he died. He owned Procter & Gamble, the company that makes your soap. He owned Johnson & Johnson, Colgate-Palmolive, and McCormick Spices. He owned banks like Wells Fargo and American Express. He owned utilities, railroads, and consumer brands people use every day. These are companies that sell things humans buy in good times and bad. Nobody stops brushing their teeth because the headlines look scary. He wasn't betting on the future, he was buying the boring present. He spread his money across many companies so no single failure could sink him. Some of his stocks surely went to zero over the decades. It didn't matter, because the winners kept compounding without a ceiling. Here's the deeper reason he chose companies exactly like these. Almost every one of them paid a dividend, and dividends were his secret weapon. A dividend is a slice of profit the company mails you for owning it. Reed did not spend those dividend checks on a nicer life. He took every check and immediately bought more shares. Those new shares then paid their own dividends the very next quarter. This is compounding wearing a business suit, and it is relentless. His passive income grew even in years when the stock prices fell. When the market crashed, cheaper shares meant his dividends bought even more. A falling market made a patient man like Reed richer, not poorer. That single reframing separates the truly wealthy from the terrified. Most people see a crash and feel their future being destroyed. Reed saw a crash and felt his favorite companies going on sale. Consider that Wells Fargo traded for under $1 a share in the 70s. Decades later, that same share was worth dozens of times as much. And every year in between, it kept mailing him dividend checks. Picture the snowball this creates once it gets rolling downhill. In year one, a small portfolio pays a small handful of dividends. Those dividends buy new shares, which pay their own dividends next year. Now you own more shares than you ever actually paid for. Those extra shares pay you even more, and the cycle repeats forever. After 10 years, the snowball is noticeably bigger and moving faster. After 40 years, the snowball is an avalanche you barely started. Reed reportedly saw returns of many thousands of % on some holdings. One long-held stock can turn a few $1,000s into a fortune. He didn't need many home runs. He needed time and patience. The dividends he reinvested quietly became the majority of his gains. Reinvested dividends are the closest thing to magic in all of investing. Now here's the habit that quietly did the heaviest lifting of all. Ronald Reed almost never sold anything. He bought ever. He kept the physical stock certificates in a bank-safe deposit box. The stack of paper was reportedly around 5 inches thick. Selling was a genuine hassle. He'd have to drive down to the bank. That inconvenience turned out to be an accidental financial superpower. Because every single time you sell, 3 bad things tend to happen. You often pay taxes on the gain you just locked in. You lose all the future compounding those shares would have produced. And you give yourself one more chance to make an emotional mistake. Reed removed selling from his list of options almost entirely. He didn't try to time the top or dodge the bottom. He simply owned good companies and let the decades do the heavy work. Here's what most people get catastrophically wrong about the market. They think activity equals progress, that doing more means earning more. In investing, the exact opposite is usually true. The more you trade, the more you pay, and the more you err. Studies of everyday investors show the most active traders earn the least. Every trade carries a fee, a spread, and a tax on your gains. Those tiny leaks, repeated for 30 years, can drain half your fortune. Diana, our busy investor, is a textbook example of this trap. Her constant buying and selling feels productive and responsible. In reality, every trade quietly leaks money out of her future. Reed's laziness about selling was worth more than any clever trade she ever made. Here's another cost that quietly eats fortunes alive over time. Most investors hand their money to a manager who charges a yearly fee. A 1% fee sounds tiny and harmless on a single statement. But over 40 years, that 1% can swallow a quarter of your wealth. The manager gets paid whether your account goes up or down. Reed never paid a professional to run his portfolio for him. He was his own analyst, his own manager, his own research department. The library gave him everything Wall Street would have charged a fortune for. By cutting out the middleman, he kept every dollar of his returns. Small fees feel invisible, which is exactly why they are so dangerous. Reed hunted down and eliminated every quiet leak in his system. There's also the trap of chasing whatever is hot this year. Reed lived through the Nifty 50, the dot-com bubble, and the crash of 2008. He watched fortunes get made and vaporized in the hottest new things. He never once chased the shiny object that everyone was buying. He owned toothpaste and banks while others gambled on fads. When the fads collapsed, his boring companies were still standing. Boring, it turns out, is a wildly underrated investment strategy. There's also a psychology hiding underneath all of this. Humans feel the pain of a loss about twice as hard as a gain. That's why crashes make people sell exactly when they should be buying. Reed felt that same fear. He simply refused to act on it. He had trained himself to sit still while others stampeded. There's another silent enemy that Red quietly defeated for decades. That enemy is inflation, the slow leak that drains idle cash every year. Money left sitting in a checking account loses purchasing power constantly. At 3% inflation, your cash loses roughly half its value in 24 years. The dollar in your pocket is guaranteed to buy less tomorrow. People think cash is the safe choice, but cash quietly bleeds. Reed understood that owning great businesses was the real protection. When prices rose, the companies he owned simply raised their prices too. Their profits climbed with inflation, and so did his dividend checks. His soap and toothpaste companies passed higher costs straight to customers. So while savers watched their cash shrink, Red's ownership kept pace. That is the difference between hiding from risk and actually beating it. The people who felt safest in cash were quietly losing the most. Reed took the boring risk of ownership and let it protect him. Now let's talk about the quiet thing that made all of it possible. Reed read constantly from the public library for free his entire life. He studied the Wall Street Journal and Barron's like scripture. He understood the businesses he owned, so he never panicked about them. Knowledge was the reason he could hold when everyone else folded. You cannot hold a company for 40 years if you don't understand it. Fear comes from confusion, and Red had spent decades removing his. He judged his life by his own scorecard, not by his neighbors. He never once cared how his choices looked from the outside. Here's the quiet truth sitting underneath his entire strategy. Reed wasn't smarter than Wall Street. He was more patient than Wall Street. He didn't beat the professionals at their fast, expensive game. He simply refused to play their fast game at all. He played a slow game that almost nobody has the temperament to win. And temperament, not intelligence, is what the whole thing came down to. Let me pull all of it together into one simple picture. Red bought good companies steadily in good markets and terrible ones alike. He never tried to guess whether next month would be up or down. He just kept buying, kept reinvesting, and kept holding year after year. When stocks were expensive, his steady money bought a little less. When stocks were cheap, that same money bought a whole lot more. This quiet consistency did the work that frantic genius never could. He automated the boring behavior and removed his own emotions from it. That is the entire machine, and anyone reading this can build it. You don't need his exact stocks or his exact era to copy him. You need his savings rate, his patience, and his refusal to panic. The tools available to you today are cheaper and simpler than his ever were. A single index fund now does the diversifying he did by hand. He built with paper certificates what you can build with one tap. The only thing you can't download is the discipline to leave it alone. Now here's the part that flips the whole story on its head. We tell Ronald Reed's story as if the $8 million is the point, but the money was never. Actually, the real secret. The secret was that Reed decided what enough looked like and then stopped moving the line. Most people get a raise and immediately raise their spending to match. The bigger paycheck buys a bigger house, a bigger car, a bigger cage. Reed got raises and simply invested the difference instead. His definition of enough stayed frozen while his wealth kept climbing. That is the one move almost nobody is willing to make. Here's the counterintuitive truth at the very center of it all. Ronald Reed didn't get rich because he learned to make more money. He got rich because he never needed to look rich to anyone. The safety pin on his coat wasn't poverty, it was freedom in disguise. Every dollar he didn't spend on appearances became a machine that paid him forever. The neighbors who pitied the quiet janitor had it exactly backward. He wasn't the poor man in town. He was the richest, and he knew it. He just measured his wealth by what he owned, not by what he displayed. Wealth you can see is usually wealth someone already spent. Wealth you can't see is the kind that quietly keeps growing. And when he died, he gave almost all of it away. He left $1.2 million to his local library. It was the same library where he had educated himself for free for a lifetime. He left roughly $6 million to the hospital that served his small town. A man the world overlooked ended up funding the institutions that raised him. Think about what that final act really tells you about him. He didn't hoard the money out of greed or fear of others. He simply never needed the money to prove anything to anyone. The wealth was never about yachts, watches, or a bigger house. It was about quiet freedom and the power to help his community. He gave more to his town than most millionaires ever consider. And he did it without a single person ever seeing it coming. The staff at his hospital and library were completely stunned. The quiet man in the pinned coat had been their biggest patron all along. That is what real, invisible wealth actually looks like in the end. Here's the one line worth remembering from this entire story. Real wealth isn't what you show people, it's what you refuse to spend. Reed understood that before almost anyone, and he lived it every single day. So what did the janitor actually know that the rest of us keep forgetting? He knew that time in the market beats timing the market. He knew a high savings rate is a superpower disguised as boredom. He knew dividends reinvested for decades turned the small into the staggering. He knew that selling is usually the mistake, not the strategy. And he knew that needing less is the fastest way to have more. None of this requires a genius, a windfall, or a single lucky break. It requires starting now and then, having the patience to be boring. The market will test that patience with crashes, headlines, and fear. It will whisper that this time is different, that you should sell. It will tempt you with the shiny thing everyone else is chasing. Every one of those temptations is a tax on your future wealth. Reed paid none of those taxes because he simply refused to listen. Your only job is to do what Ronald Red did and not flinch. Start with whatever you have, even if it feels embarrassingly small. Automate it, ignore it, and give it the decades it needs. The hardest part is not the math, it is the waiting. But the waiting is exactly where all the real wealth is hiding. The most important financial decision you can make is knowing when enough is enough. Do the math, start early, and let the decades do the heavy lifting. Make the decision that matches your reality, not someone else's sales pitch. If this showed you something about money you hadn't seen before, subscribe to Desmond Wealth. We break down the hidden math behind the financial decisions you face every day. And the next time someone says you need a big salary to get rich, ask them one question. Ask them how a small-town janitor quietly retired with $8 million. The answer isn't a secret, it's just patient and it's waiting for you.